So the topic this afternoon, oil and water. Are crypto companies compatible with traditional public markets? Crypto M&A reached some of its highest levels in 2025. So there's 130 or more deals with no signs of slowing down. But others took, some took traditional capital market paths such as IPOs. Others did M&A, and there were a number of tokens being launched, as we know. A new paradigm is emerging as crypto matures with different pathways, with different hurdles facing acquirers, investors, and those wanting to be acquired or go public. So with respect to token issuance and public market listings, is it either or is it both and? Can you both issue a token and go public, or do you have to pick a path? So with me are the esteemed panelists. So we have, from the end, Scott Lawin, president of Pantera Capital, so one of the leading VCs in the space, who will talk more about the early stages of investing. In the middle, everyone's familiar with Brad Garlinghouse, CEO of Ripple, leading one of the most established global blockchain companies focused on cross-border payments and enterprise adoption beyond crypto natives. And next to me, Chris Ferraro, president and CIO of Galaxy, overseeing buy-side activities for one of the industry's leading institutional platforms that spans trading, asset management, and investment banking. So I think between you, you'll be able to figure this one out. Just before we do, can you pop that questionnaire back up on the screen? I thought that was interesting. So this was a question that was asked to the audience before the event last year and before the event this year. So the one last year, more public listings, 51% of you said that there'd be more public listings, and this year it's only 37%. So people are more bearish coming into this year. So people actually think there'll be fewer public listings and less VC activity. So that's a kind of bearish signal for this year. And also consolidation due to a slowdown in the industry. More people said that would happen this year. So I thought that was quite interesting. Maybe people are looking at the Bitcoin 4-year cycle. So it's up, 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 down. And last year was the third year of the ups, and now it's down. So maybe that. But does anyone have any thoughts on? Does this make sense to you? Does this resonate or not?
I think it has a lot to do with the enthusiasm around the change in administration a year ago, the sense that we were going to have real progress right on the regulatory and legislative front, and I think the 4-year cycle probably played into that as well. I think where we are now, maybe that enthusiasm has dampened a bit. Doesn't mean that it's necessarily gone away, but maybe
it's the morning after effect.
Yeah, the rosy glasses are a little less rosy for the year ahead.
I'll also throw in, I think on the bearish side, the consolidation point, I think there is more focus now on you need to really have proof that you're solving some problem that customers are going to pay for. You can scale into it. And you've seen some things like, okay, that's a super interesting science experiment, but is there really a there? And so that to me is maybe the increase in the consolidation point.
So it may not be due to a slowdown. It may be due to product market fit and useless stuff goes away.
I mean, I doubt you're going to find many people here attending this event who think there's going to be I think most people are pretty optimistic about the year ahead around crypto broadly. Maybe I'm wrong about that. I shouldn't speak for everybody, but I certainly am, as optimistic as I've been in a long time about 2026, and that's largely because institutional shift around crypto and blockchain adoption and comfort level.
Yeah, I think 0% barbell effect is a crazy number, actually, because I think that it's clear that new ideas are getting funded. They're getting funding with very increasing rapidity, particularly around global money movement, stablecoins, et cetera. That's happening in real time. And the biggest companies have a big advantage because they have capital and they have access to capital. And I do think everyone in the middle in 26 is trying to figure out what's my lane, because the trajectory is changing so fast, the landscape. So I'm over on 0.
And that was to Brad's point as well.
I'm a buyer all day.
So why didn't you do you should have filled in the questionnaire?
I think people in crypto have ADHD and they couldn't read all those words.
Yeah, it's a long one.
That's too long.
It's too long. Can't read. Scott, touching back on your point on the legislation. So everyone was excited when Trump became president, and now we've got this kind of hangover effect. Something interesting happened last night for those of us who were in Switzerland. Something about the Clarity Act and some members of the industry kind of pushing back on the Clarity Act. So I'm wondering, will it pass? Will it not pass? Or why do you think some of our colleagues are so publicly now against something which we were all for, like regulatory clarity, once like as near ago as like a year ago?
Yeah, I mean, listen, I think it's unfortunate, right? At the end of the day, it's probably not unusual before something, gets to the finish line for there to be horse trading at the end. And again, the biggest players, doesn't matter what industry it is, are going to exert that pressure at the end to try to get what they want. I think the real question will be whether this is ultimately just something that slows it down, right? While this gets sorted out and we ultimately get something done. That would be my expectation and the hope. The risk, I think, for everybody in the room in the conference is that it actually gets stuck and the timing gets extended, potentially through the midterms, and then you have a real risk that nothing happens. I don't think that's the outcome I would bet on.
Is there a poly market on this? There should be, right?
I'm sure there is.
I'm sure there is. Will Clarity Act pass within the next?
Yeah, but I mean, listen. In the last week, you saw 80 amendments, sort of, flow into the end, and so, it will sort itself out. But there's going to be some struggle.
I mean, I'll just add on that. I'm always an optimist. Look, we have never been closer.
Yeah.
And the thing I feel super strongly about is we have been living in a world of kind of chaotic, and you've seen that play out in the former SEC, not under Atkins, but certainly the former SEC. And so anything is, from my point of view, better than where we have been. And I think we as an industry should not lose sight of perfection is the enemy of done. And
you'd rather have something out there that you can navigate.
The Genius Act wasn't perfect. It isn't perfect. It's better than not having the Genius Act. The latest, Banking Committee, Clarity Act, Market Structure Bill, it is not perfect. And I think Brian Armstrong and the Coinbase team have raised, fair concerns. I was surprised how vehemently they came out and said, look, we can't support this. The rest of the industry really is still leaning in and supporting it, and I think constructively trying to work through, okay, there is a number of steps before you get to the point of it coming to the Senate floor. So let's continue to engage. We have never been closer, and now is not the time to kind of throw our hands up and say...
There might be some brinkmanship or something involved, but let's get it done is we're
really close, and it's good for the industry. Again, I'm not at all trying to argue it's perfect, and I could poke holes in the yield point and some of the things that Coinbase has pointed out. I think those are fair points, but is it worse than the kind of chaotic lack of market structure that we've been living in? That's a hard argument to win.
Yeah. I agree with a lot they said. I think it's dangerous, right? With these things, there becomes like a game theory prisoner's dilemma thing, and I think it's a little dangerous when you have big market participants who put their own interests forward, thinking that, well, I agree something is better than nothing, but maybe if I hold out, I can get something that's better, and you ride that fine line between a really bad outcome. So that last night that started, unfortunately.
So please don't do that. Let's get it done, guys.
Yeah. As Scott pointed out, the downside here is this gets a protracted renegotiation, and you do see it flow into the summer and the midterms, and now all bets are off. Like something not passing, I think, would be much worse. Like,
that's not going to be good for IPOs. It's not going to be good for VC.
Correct.
Yeah. Okay. Cool. Thank you, Brad. First question for you then. $40 billion in your last private round, reportedly. So when listing, or is the fact that you issued XRP holding you back?
Well, certainly, I mean, we had a long, protracted argument with the United States government and the SEC about whether or not Ripple issued XRP, and we won that case. So Ripple didn't issue XRP. XRP, we own a lot of XRP, and we care a lot about it.
Your DAT. In
some ways, Ripple was the first DAT. That's a hard argument not to, yeah, that's true. What's interesting, though, even at $40 billion, Ripple's at a big discount to net asset value, where most of the DATs have traded at par or big premiums at times. Look, I mean, we have not prioritized a public offering for a whole bunch of reasons. We feel like we've been able to play offense, and that's a shift. We spent 4 or 5 years playing defense with the United States government. Now we're playing offense. A couple of very consequential and strategic acquisitions, both in Hidden Road, which is represented here, and that has been a game changer both for Ripple and I think for that team. seeing literally a massive increase in business by virtue of having a much bigger balance sheet than more recently. And I think one of the things Ripple has done differently, our acquisitions have been outside of crypto. So we bought the second largest treasury management platform called G Treasury, which has zero digital asset activity. And the idea is these guys are the orchestration layer, the CFO dashboard orchestrating $13 trillion of payments last year. That's a humongous opportunity to introduce stablecoin payments, even prime clearing services.
So you bring all those into the crypto fold.
That's correct. Yeah. And look, on their platform, they can see because again, they have visibility of what the CFO sees, so they can see these things. There's $300 billion of deposits they see that are basically getting zero yield. Okay, let's introduce them to stablecoins. And yes, Ripple, RLUSD. Now, not only do you have an opportunity to get some yield, you have 24/7 access and ability to move that money, which you didn't have before. And I think this is how we expand the crypto community beyond the echo chamber, which is a powerful, awesome echo chamber. Yep. But we got to expand it. And I think the best way to do that is to look at assets like that can really bring those customers into these solutions.
Cool. So staying private, making more acquisitions from outside of crypto, not just buying crypto natives and bringing those tools and facilities for your clients.
Well, I don't know that we'll be particularly acquisitive this year. We did a lot. We did 4 acquisitions last year. That was a busy year, and I think we focused on integration and capitalizing on some of the synergies we see between the companies. But we have definitely not prioritized an IPO in the near term.
Well, Chris, Galaxy is listed, publicly listed, and you oversee the balance sheet M&A.
Yep, I do.
So you have a good perspective from an acquirer. So does being public help or hinder your ability to acquire companies in general, and specifically for acquiring crypto companies that have issued tokens? So if a crypto company has issued a token, whether it's through a foundation or from itself, is that easier or harder? What are the different considerations from your seat when you look to acquire it?
Yeah, super challenging to do that. The main reason is, I have a very big nuanced answer to this, but it'll get too complicated. On this particular topic, when you buy a crypto company that already has a token, you all of a sudden now have multiple stakeholder groups, right? From our perspective, if we're going to buy a company, we want to acquire a team, great technology, hopefully an existing business, roll it into our company, we're all aligned, and off we go and build. And instead, when you buy a company with a team that themselves not only have perhaps some equity in their company you just bought, but also have token allocations, which have been sold separately to other people who don't have a stake in the technology you just bought, now all of a sudden you have this really big agency problem when you bring them in. You say, okay, well, do I have to buy out all the token holders too? Do I have to buy the token holders and give them equity? I don't want to do that because that's 3 times the price that I thought I was going to pay.
But token holders generally don't have any rights anyway. You don't have to do anything with them, but they're noisy.
I think token holders expect ultimately to be aligned with the outcome of the thing they put money into, right? And so whether they have rights or not, the reality is if you're going to buy a tech team that launched a protocol that has tokens, just think about that. If we bought in a team and we said, okay, we're going to do an all stock deal, so you get Galaxy equity, because of course, if Galaxy wins, you win, everyone wins, but they also own their tokens separately. And I say, look, I don't want you guys to work in that protocol anymore because we're going to do this. What are they going to do? Well, it depends on, do I think I have more money in Galaxy now, or do I have more money in my tokens? And so to me, equity out in the world versus tokens out in the world is all about stakeholder incentives and management. And you got to be super clear about what those are and make sure you have your eyes wide open about whether you're going to get the right outcome based on what people's incentives are. That's what makes it complicated.
You guys are sort of living the back end of the conversation that we have with the companies that we're investing in, right? So, depending upon what the business is, the question is, are you building your company to be an equity company, right? Are you building your company to be a network company, right, funded by tokens? Are you creating a business structure that has both, right? And at the end of the day, it's not an easy thing to do, but you want to create a structure where there's alignment, right? Where if the equity company owns the IP and the revenue, right, and they're using the network, that there's some commercial relationship, right? That there is that alignment between the two. But ultimately, when you sort of get to the end of the road, which is, are you going public? Are you getting acquired? There's that tension because you have those two different stakeholder groups, 100%.
So Scott, I'm going to push you on this one a little bit. So as an early stage investor, one of your commitments you have to your investors, your limited partners, is distributions, giving them money back. So one of the things you could advise your portfolio companies is, hey, this is the wrong time for publicly listing. The business isn't really an equity business. You should launch tokens. That gives you your exit, potentially, and then you can return capital back to your investors. But that puts that company in a difficult position for getting acquired by the Galaxies of the world. So are you I'm sensing some divergence in recommendations here.
Well, I mean, listen, I think at the end of the day, our job, right, is to make investments and advise our companies in a way that creates the most value, whether that's through equity ownership or through tokens. That really is about creating great products, right? That there's real demand for. Particularly at the early stage when you're investing, it's hard to, sort of predict, okay, this is going to be a company where the token accrues 80% of the value and the equity does nothing, or sort of vice versa. I think what we're, the easy answer is we're trying to look at the long-term outcome of what this business is and what this business can be. Along the path, certainly for our own LPs, they love having, DPI.
I love
and
DPI.
so when they're, and again, our strategy is to invest not just in equity, right, but to also invest in early stage private tokens and, liquid tokens along the way. So it is this sort of blended approach. We like it and our LPs like it because as you go through the market cycle, sometimes, equity's cheap and tokens are expensive, and sometimes it's vice versa. But I don't think we make an investment, day one saying, there's only one path to liquidity or only one path to value.
So do you find yourself in conversations then with founders, not necessarily giving them advice or steering them, but just in conversations like tokenized now, IPO later? So I'm coming back to this either or both and kind of question. Or is it usually like you're a token company versus you're a company that potentially could get acquired or go public in the traditional equity sense?
I think it just really depends on what the business is, right? Like if it's a protocol business, it's a token company, right? If it's a product business, it's likely an equity company. But as they develop that product, there may be a token opportunity along the way, right? So I think it goes back to ultimately like what's the customer base, what's the product market fit, and then what's the monetization vector, again, through the cap structure, right? Could be equity, could be selling more shares along the way, could be creating a token to, monetize and engage the customer base.
Yeah. I think they have been mutually exclusive. I don't think they have to be mutually exclusive, but I think practically there's a null set as far as I can think of in terms of like big successful public companies that have gotten out and also had a big successful public token, because they're almost the same thing, right? I mean, I'm going public with this token and it has a set of properties and a business model, or I'm going public with my equity. But there are public companies.
That was quite an interesting point, right? No examples of large successful companies that have both issued a token and are publicly
I could be missing one. Like if Coinbase launched a base token, that would probably be the
I think maybe the answer is yet.
Yeah. And the ordering might matter. It might be easier to list first. You should issue a token, get some more money.
Don't say that to Novo, because
that's the problem, right? Like some of the token issuance are, I think, momentum chasers who are like, this is an opportunity, I should just issue a token. And the token, even to what we just described, like it doesn't have utility, it doesn't have a purpose, and that I think is
so they haven't thought through the utility value of the token.
And usually that happens, they've thought through at the Pantera stage, not the Galaxy stage. We have seen companies late in life be like, I got an idea, I'm just going to insert this token into, and it's like, no.
IPO window shut, let's do a token instead.
Well, like you can imagine a public company that has, a business that looks like an annuity where they say, okay, there might be a better way to a better cost of capital if I issued a royalty, for example. And like, so I could issue a token that's effectively like a royalty on revenue on one of my divisions. Like I can envisage a world where that happens and it's really vibrant and rampant and it's not totally incompatible with being a public company. I would love to see that happen. I don't know why it hasn't yet.
So maybe,
which is why we need clarity,
Yeah.
right?
Right. It does go back to why it's so important.
Yeah.
I mean, whether there is oil and water between tokens and IPO or not, one thing that I know, if we don't get a market structure bill passed, this is going to continue to be fraught with problems, and particularly if an administration change in a few years and what have you.
go back. I mean, I can imagine in 5 years or so time, maybe it's not even 5 years, that at business schools you're taught, currently you're taught there are two instruments to raise money, equity or debt, right, more or less. Yeah. Maybe one day in the future there are three instruments to raise money, equity, debt, tokens, and here's the differences between them, and there's regulatory clarity between them, and if it's a token it can't have these properties, and if it's that, I can imagine that kind of syllabus being taught.
Yeah, I mean, listen, there's Harvard Business School case studies on Bitcoin and ETH right now, right?
I think on Ripple too, actually.
Yeah. All right, there you go.
There we go.
I think once you have a legislative framework, right, where people are thinking more broadly and creatively about capital formation across equity and tokens, you're absolutely going to be taught that in school, right? It'll be a new path towards raising capital and engaging customers, right?
Right. Okay, one for the audience here. So imagine we're sitting in the audience and trying to weigh up the trade-offs, the pros and cons, the benefits of either publicly listing or issuing a token. So how, from your experience, how do you weigh the trade-offs of public listings, which is access to capital, certain pools of capital, liquidity, the brand value of being on the NASDAQ, versus the cost of disclosure and the short-termism that comes with quarterly reporting and the regulatory scrutiny? So you've got a set of trade-offs when you IPO versus the set of trade-offs when you issue a token, which is generally, I mean, you get your money and you get community loyalty in a different way than shareholders. But you have typically a very volatile. Typically, tokens are more volatile than equities. So that's another set of trade-offs. So how do you? So firstly, challenge me on those trade-offs. Have I missed anything? And secondly, how do you weigh them?
Yeah, I'll take first crack at the public stuff. So, to me, being public is a decision Galaxy made, and we would never have undone it. You pointed it out. It's about credibility and access to capital markets.
You had a journey for being public that some people might not appreciate.
We did. Yeah. 2 seconds. We actually went public in 2018 in Toronto, on the Toronto Stock Exchange, via a sort of kooky reverse merger, almost like a SPAC type transaction way back in 2018. With an intent to very quickly move to the U.S. capital markets. The reason to be public, everyone hear me loud and clear, is for our credibility on the main stage and access to capital. And so, and the U.S. markets are the best place to do that, I think, undoubtedly. And so our intent was to do that, make that transition relatively quickly. And then we got steamrolled by the Gensler administration and went through a lot of pain and suffering, and cost us a lot of money. Eventually, we got through last year and moved our listing from TSX to NASDAQ, and we've been a U.S. public listed company now for a little under a year.
Dual listed?
We are still dual listed. There's not a whole lot of benefit to it. We've been trying to get rid of Canada.
Sorry, that was a bit of a side question.
No.
Back on the.
No, but on the main point, if you're going to launch a token or you're going to go public, it's very hard to undo. So when you make that decision, you are making that decision for a multi-year period. You're going to live with the consequences. Very hard to get to undo. Credibility and capital, but there's nuance underneath it, right? And so for crypto, the credibility for us as a business, Galaxy historically has focused mostly on institutions. All of our customers are big, either corporates or funds or whomever. Crypto being a very historically opaque, less trustworthy, smaller industry relative to the big financial system, being public was actually the thing that helped us win business all the time. I'd rather do business with a public company than a private company.
Because of disclosures, audits,
100%. That's the good thing. Access to capital is a really interesting one, right? There are plenty of private companies that have tons of access to capital. It just comes in different forms, right? As a public company, and this is why being a public crypto company, it tends to be good, is volatility, which crypto has in spades, actually creates opportunities to raise capital in the public markets that people shouldn't ignore. Like you can issue converts because convert investors love to trade vol and they get it cheap all the time when they buy crypto vol. And so therefore you have an open spigot to raise money for converts. You don't have that as a private company because they can't trade the underlying. So you have access to capital at scale fast if you need it as a public company. As a private company, and Brad could talk about it way more than me, like, it's a slog always, and then you get your capital, and then you better do something with it because like you might not get another shot with it.
Thank you.
Three quick observations on this. One, as everybody in this room knows, the private capital markets, and frankly, you know better than anybody on this stage, the private capital markets are larger than they've ever been. And so, where it may have been 20 years ago, the only available path to access big sources of capital in the public markets, that's not the case today. Two, frankly, even Ripple doing $500 million from Citadel and Fortress, that's 20 years ago, that would have been a massive check. And now it's kind of, frankly, not very big. Second observation, there are more examples of private companies staying private for a very long time. Stripe is, maybe the most well-known example of that, but there's a whole bunch of examples of companies that now, they don't need to go out into the public markets. Maybe at the margin, it constrains acquisitions because you don't have an extra form of currency in a public.
Your shares. You can't buy through,
right?
yeah.
Look, the third thing, and you've referenced this, being public has a bunch of, not just the disclosure stuff. Look, I think Circle's IPO was a watershed moment, and I think great for the industry, and I think great for Circle. And I'm glad I'm not Jeremy Allaire trying to manage my employees' expectations when their stock that they valued at $230 a share is now at $80 a share. And that sucks. On one hand, had you started at $80, people would have been thrilled, right? Like that's a great outcome. I think that puts them at a 15 or $20 billion market cap. That's an A+ outcome of the IPO. The problem is, they've got 1,000 employees plus or minus, and some of those were doing their personal net worth calculation at 230, and now they're pissed.
So, pointed question: don't you have the same challenge with your staff and XRP?
No,
or in a different way, perhaps.
Well, we primarily, we do a traditional. We give people equity in Ripple.
Right.
Ripple doesn't trade publicly. We've done a bunch of tender offers at increasingly higher prices. That's what they're
happy
care
with
about because that's where they're getting liquidity. So a bunch of our employees own XRP for sure.
But that was their decision.
Yeah, that's and XRP. And look, the counsel I give our employees all the time is the measure of our success is not. Don't focus on the price of XRP and as we talked, the volatility there. That's a bad way to focus and manage your expectations.
I think the bottom line is not every company should be public, right? Like at the end of the day, as a public company, you obviously need to deliver revenue, but you also need to deliver understanding of what your underlying business is. And markets actually public markets don't do a great job of understanding complicated businesses and appropriately valuing those. And so that's why you'll see, some companies have a great IPO and then over time the stock hasn't performed and they decide to go private again, right? Again, those can be great trades for insiders as well. But, crypto at least at this point in the industry, we still have a lot of education to do. We have a lot of understanding that we need to sort of deliver. And so the risk, on the other side of the access to capital is that once you are a public company, if you don't have that follow through, if people actually don't understand the story and the narrative, you might have performance.
Yeah, 100%. Yeah.
I just want to make one point on that. It's like talking against being a public company, and Brad, I think, is like a perfect comparison.
Poster boy
to us. Yeah. Like, and this is not to imply that you do this, but when it comes to M&A, for example, if we go to look at a company to buy, like my currency is my cash that I have and my public stock. And my public stock, I don't control the valuation, right? Obviously, like the market determines it. If it's a shitty 3 months and like we don't show a lot of growth that quarter, or Bitcoin's
down,
got
the narrative right, or
right, then I get punished for it, which means it's harder for me to buy a company. Brad has a better ability. He can convince someone, another founder, Ripple's not really worth 40 billion, it's worth 80 billion. Here's why, right? And then the founder could say, oh, you're totally right, I'm a buyer at 80 billion, and he could do a deal, right? And
so earlier we were saying that being public helps to, but now we're saying
double-edged sword.
Yeah, right.
You can have access to capital, but you're exposed to the whims of the market every day.
Yeah, you could be undervalued. Yeah.
I agree with that. We we have used Ripple Equity as a private company, but look, I think, again, lots of astute investors in this room, private to private valuation marks are often kind of like, huh? Yeah. Like, you don't know what to make of them sometimes. I mean, most of our acquisitions, we're using, a mixture of cash and equity, and so, it depends on the circumstance. I will say, we haven't said it yet up here, I hope everyone in this room is rooting for the BitGo IPO. Like, if BitGo goes well, that's great. And back to the survey we saw earlier, I think we should all want that to be a successful outcome, and we'll see where it trades.
Absolutely. Absolutely agree. All right, 1 minute left. Should we do a lightning round question? One thing, each of you, you'd like public market investors to better understand about crypto businesses. Scott, do you want to?
I think
they're buying your bags.
Yeah. I think just that there are multiple paths to liquidity, right? Sort of back to our kind of equity and token thing. I think metrics are also important, right? I think public market investors focus a lot on the volatility in the industry, and they focus a lot on price, right, of sort of the majors. They're focusing less on actually the real on-chain revenue that's being, delivered. And so I think, again, that's part of that education around the industry of like, there are real businesses generating real revenue with real customer growth.
So stop looking at the token price, look at the actual
look at the underlying business.
Yeah, okay.
I have a slightly different answer. I think one of the most fascinating, I say this partly as a personal basis, I don't do a lot of personal angel investing anymore, but I find it absolutely fascinating to see what goes on in the secondary markets, the private markets of equity markets, and things that trade at a massive premium to the last private round and things that trade at a massive discount to the last private round. The
variance is huge in it. Yeah.
It's unbelievable. And the lack of efficiency in those markets, actually, I do think, it creates opportunity. Yeah. You haven't seen that many funds historically focused on the secondary market. And I would bet because of some of those dynamics, you may see more of that going forward.
Yep. So secondaries, private equity, secondary funds. You should spin one up, Scott.
There you go.
There you go. Chris.
Try to ignore quarterly variations when you're investing in a crypto company, so you're missing the point. And put your dividend discount model and WACC and DCF model to the side a little bit, and dream a little bit, because that's what this whole industry is thinking about, decades forward TAMs and different ways of thinking about value accrual. And so if you're really going to invest in the space, you gotta untether a little bit from.
Pun intended.
Yeah, exactly. I think that's a wonderful, wonderful way to end the panel. I think we can all dream a little bit. Let's show our appreciation to the panelists. Thank you very much.
Thank you.